For more on the markets and the economy, let's bring in CNBC contributor Peter Boockvar. He's a Bleakley Financial Group Chief Investment Officer. Peter, always great to have you. You think 10-year yields are going to hit 5%? What happens to stocks in that scenario?
Well, just to add some what Tim was saying is it helps to self-actualize. Do you want to be paying 22 times forward earnings in that rising rate environment? When rates are low, investors can be very valuation agnostic. When investors believe that the Fed is going to cut short-term interest rates and save us, investors can be valuation agnostic. But when you hit the reality that interest rates have actually risen across the curve in the face of those rate cuts, and now the Fed may not even cut again, well, valuations may all of a sudden matter. And instead of 22 or 23 times, maybe 20 times is more appropriate, maybe 17 or 18. Well, if that's the case, then it's going to be tough for the market to drive much higher. Now, the market can say, okay, we're comfortable 22, and we can sort of not have much of a return this year if we've already priced in a lot of the gains. But this P multiple now all of a sudden becomes an attention focus if these rising rates continues, which I think it will. And yes, 5% I do think will be touched again that we saw last summer.
So markets go down in your view, Peter. I mean, that's the bottom line. And is the bar for a Fed rate hike much lower in your view, or is that still off the table?
I don't think that's not where the Fed's head is. And I look at the payroll number today, and it just doesn't square with anything else I'm seeing. To me, job growth is probably more around the 150 level, because while we celebrated the 256, which does include about 30,000 plus of government, ADP on Wednesday said private sector was just 122. I think the truth lies somewhere in the middle, and it's probably about 150. And that's a slowing rate of job growth relative to 2023. So I don't think the Fed's head is there. Now, of course, the inflation data next week is going to be big. If there's one thing that can sort of take the heat off interest rates, it could be a benign CPI number, which I think the services component can deliver that. But there's also more that's going on here. It's the global rise in interest rates. I mean, you essentially have the global bond police that's driving through all the different neighborhoods around the world and calling out governments that have excessive debts and deficits and wondering whether they're going to be able to sell that at the price these borrowers want to sell at, whether it's Japan, whether it's the UK, France. And it's now becoming wider spread. It's falling into Germany, which is economies in a recession and with higher interest rates, and Australia and Canada. And also one last thing with rates that's not really being discussed around markets is the Bank of Japan is probably going to raise rates this month, and they continue to reduce the pace of their QE. Through the first quarter of 2026, they will have cut QE in half. That is a major liquidity spigot that's being turned off that I think is behind the scenes impacting global interest rates, just as it did last summer when they eliminated yield curve control and the U.S. 10-year yield within days started its ascent to 5%.
Peter, when you look at the revisions that we've seen last year in the jobs numbers, we saw the biggest revision since 2009. Do you think that could be a little wonky in the differential that you talked about? And secondly, when you take out Mag 7, you're concerned with valuation. When you take out Mag 7 and you look at forward versus forward without Mag 7, it's a couple of percentage points different. When you look at current, it's about 10 handles different.
Agreed. You can drive a truck between the P multiples of the growth stocks and the multiples of the value stocks. I think this is the ideal situation where value finally catches up to the growth trade, and that the stocks most vulnerable are those growthy high PE multiples. Those that are less vulnerable are the cheap value stuff. Now, with respect to the revisions, when you think about here we are just a week after December ended and the government is supposed to come up with an accurate jobs number. It's just physically impossible. And that's why we get a revision next month, a revision the following month, a revision a year from now. And that final number is going to be very different than what we heard today. And it's also just because of there are less businesses that are responding to these surveys and so on and so on. So that's why I think when you analyze the jobs data, you got to look at it all together with a lot of different data points.